Ask most people to name America's worst modern financial crisis, and they'll say 2008. Almost nobody mentions the crisis that came before it, one that cost American taxpayers more relative to the economy, took down over 1,000 financial institutions, and helped send several bank executives to prison. This crisis doesn't get the documentaries. It doesn't get the movies. But by many measures, it was worse than most people realize. This is the story of America's savings and loan crisis, the financial disaster history quietly forgot. To understand this crisis, we first need to understand what a savings and loan institution actually was. For much of the 20th century, savings and loans, often called thrifts, were relatively simple, conservative institutions. They took in customer deposits and used that money almost exclusively to issue home mortgages within their local communities. It was a stable, unglamorous business model that had worked reliably for decades. But by the late 1970s and early 1980s, this stable model came under serious strain. Interest rates in the broader economy rose dramatically, while many thrifts were still locked into older, lower-interest mortgages issued years earlier. This meant many of these institutions were effectively losing money on their core business, since they had to pay depositors higher interest rates than they were earning on their existing loans. In response, the U.S. government made a decision that seemed reasonable at the time, but would ultimately prove disastrous. It significantly deregulated the savings and loan industry. Throughout the early 1980s, new legislation dramatically loosened the restrictions on what savings and loans were allowed to invest in. Previously limited almost entirely to conservative home mortgages, these institutions were suddenly permitted to invest in much riskier ventures, commercial real estate developments, speculative construction projects, even high-risk corporate bonds known as junk bonds. At the same time, deposit insurance limits were increased, meaning depositors had less incentive to worry about how risky their bank's actual investment strategy had become. Many savings and loan executives, eager to escape the financial strain of the earlier interest rate mismatch, aggressively pursued these newly available high-risk investments. Some institutions grew their assets extraordinarily quickly, chasing rapid growth and higher returns with money that ultimately belonged to their depositors. Regulatory oversight during this period, meanwhile, was significantly weakened, and in some cases, thrift regulators were understaffed or lacked the resources and authority to properly monitor the increasingly risky behavior spreading across the industry. As this risky lending expanded, something more troubling began emerging alongside it: outright fraud. Some savings and loan executives engaged in deliberately fraudulent practices, issuing loans to related parties or business partners with little genuine scrutiny, artificially inflating asset values, and in some documented cases, essentially looting their own institutions for personal gain, all while depositors' money and federal deposit insurance provided a dangerous safety net that delayed the consequences. By the mid to late 1980s, the underlying problems could no longer be hidden. Real estate markets in several regions, particularly the Southwest United States, experienced significant downturns, and many of the risky commercial real estate loans savings and loans had aggressively pursued began defaulting in large numbers. Between the late 1980s and early 1990s, over 1,000 savings and loan institutions failed across the United States, a staggering number that dwarfed almost any previous banking crisis in American history up to that point. Because deposits at these institutions were federally insured, the U.S. government, and ultimately, American taxpayers, became directly responsible for covering the losses. In 1989, Congress passed major legislation creating the Resolution Trust Corporation, a government agency specifically tasked with managing and selling off the assets of failed savings and loan institutions. Over the following years, this cleanup effort ultimately cost American taxpayers an estimated $124 billion, and when accounting for the broader economic impact, some estimates place the total cost of the crisis well over $150 billion. Unlike many later financial crises, the savings and loan collapse also resulted in significant criminal accountability. Over 1,000 bank officials were convicted of crimes related to the crisis, including fraud and embezzlement, a dramatically higher number of prosecutions compared to what would follow the much larger 2008 financial crisis nearly 2 decades later. The crisis fundamentally reshaped American banking regulation, leading to stricter oversight requirements and higher capital standards for financial institutions, reforms that, in many ways, directly influenced how regulators would later approach, and in some cases failed to fully apply, oversight during the much larger crisis that followed in 2008. Here's why this crisis deserves far more attention than it usually gets. It's arguably the clearest American example of what happens when deregulation, weak oversight, and outright fraud combine inside institutions that are holding the public's money. And it raises an important question, especially given how much less attention this crisis receives compared to 2008. Why do you think this crisis has largely faded from public memory, despite its massive cost and scale? Thanks for watching. I'll see you in the next one.